Hello, ladies. So we're looking at the next chapter in Theme 1, which basically is Chapter 19 on Theme 1, as I mentioned, markets, consumers and firms. And we're going to be looking at calculating revenues and costs. Now, we have covered this informally in previous lessons, but this is a bit more of a formal presentation in terms of some of the things that we need to understand and some of the interrelationships between revenue and costs and average costs, etc. So it's only a relatively short presentation, only 15 slides, but it gives quite a nice introduction to this whole area. So without further ado, let's get on. Okay, so first of all, posed a question for you. If you were going to sell Krispy Kreme donuts during one lunchtime next week, how many do you think you would sell? What do you think they're going to cost you, and how much revenue do you think you would make? So if you want to just give that some thought, jot a few numbers down, and then obviously we can refer back to that at a later stage, perhaps when we do our live catch-up later on in the week. So I'll give you some time to give that some thought, and then we'll move on. So let's move on and take a look at the next slide. So what we're going to be doing here is looking at how you calculate sales volume and sales revenue. We're also going to look at calculation of average, fixed, variable and total costs, and also calculate percentage change in figures, which are all quite important, as we've seen in various different activities and exercises we've done. Simple math, simple interpretation of maths, and particularly percentage changes is quite an important one to get your head around. So first and foremost, I'm going to look at sales revenue and sales volume. Okay, now effectively, we know that from what we've looked at in terms of businesses and the objectives that they set, in some cases they might choose to increase sales volume whilst actually reducing sales revenue. Now, obviously, if we're going to produce more volume, we can sell more volume, we could become a market leader or talk about the growth of our market share, etc. And we could use that in our marketing to be seen as a growing force and becoming bigger. And so in some cases that might well happen, dependent on what the business objective is. Okay, but more often than not, we talk about sales volume and sales revenue as one of the important principles. Okay, so let's take a look at this in a bit more detail. And sales volume is basically the amount of sales expressed as the number of units that you've sold. So the volume of items that you've sold would be, and the number of units would be, your sales volume. So for instance, an example, if we sold 20 tons of wool, that would be the sales volume that we've sold. The sales revenue is the amount of sales expressed as the total sum of money spent by consumers. So in this case, if we sold 20 tons of wool and we sold that at £10 per tonne, then that would give us a total sales revenue of £200 in total. It would be very expensive, that would it? But probably not particularly realistic. But fundamentally, that's the difference. Okay, sales volume is the number of items that you've sold. Sales revenue is the amount of money, the total sum of money that consumers have spent on those goods or services. So, for instance, again, another example: if we had sales revenue £3 million, that would be expenditure on clothing. That would be sales revenue in this instance, if we were a clothes seller of some description. So, how do we calculate sales volume? A couple of ways we can do it. One is to take the sales revenue, the amount of money that we've, the total revenue, the amount of turnover that we've achieved, and divide that by the selling price that we have charged our customers, and that would give you the number of units that we've sold. Okay, so here's an example. Then the company has sales revenue of £50,000, selling price is £2.50. So our sales volume in that situation would be 50,000, which is our total sales revenue, divided by £2.50, our selling price. So we've sold 20,000 units in terms of sales volume. Now, sales revenue can be calculated quite easily too. So in this instance, we need two things. We need to know what our selling price is and what the quantity, the number of items that we've sold, and that would give us our sales revenue figure. So if a company sells 20,000 units, the selling price is £2.50, then in this instance the sales revenue would be £50,000. Okay, so effectively selling price of £250, quantity sold 20,000 units, so times the two together and we get our sales revenue figure. So pretty straightforward really, but that's something we've certainly looked at before. Okay, let's move on. So one of the things that you can do, as you can probably see based on the last slide, that if you've got sales volume, selling price and sales revenue, you can basically work out whichever one you haven't got, if that makes sense. So if you know what your sales revenue is and you know what your selling price is, if you take your sales revenue, divide it by your selling price, that gives you your sales volume. If you know your sales revenue and you know your sales volume, if you actually divide your sales revenue by your sales volume, that also gives you your selling price. And then if we want to calculate what our sales revenue is, if we take our selling price and times it by our sales volume, that will give us our sales revenue. So it's quite a nice triangular formula to remember there. Okay, and provided you know at least two of those, you can calculate the third. Okay. So let's take a look at revenue in a bit more detail then. It's a term that's used quite a lot in business and in economics, but also if you hear the term turnover, sales, sales revenue or total revenue, basically referring to the same thing, okay? Just designed to confuse us, but fundamentally all of those terms mean exactly the same thing, okay? So the revenue that you achieve is the money coming in from the sale of goods and services. And to get our revenue, our total revenue, we take our selling price and times it by the quantity that we have sold. So again, another simple example, a business sells 20,000 units and the selling price is £15. The total revenue that we would achieve would be 15, our selling price times by 20,000 units, which would give us £300,000. Now, if we talk about revenue and the way in which that might be shown graphically, well, effectively, if we sell nothing, we sell no units, then basically we have no revenue at all. So effectively, our revenue is going to increase with the amount of units that we sell. So it's going to start at zero and it's going to slope upwards when shown on a graph, as we've shown at the bottom, in the bottom right-hand corner of this slide. Okay, so we've got sales revenue in terms of pounds, and then the number of items sold. And as we sell more items, then obviously the rate of sales revenue increases, and is an upward sloping line on the graph. Now then, let's take a look at different types of costs then. So we know we've talked about revenue there, okay? We've calculated how much we sold our goods for, but we also need to understand what our costs are. In order for us to be able to calculate profit, we need to understand what our costs are too, okay? So we've got two different types of costs, as we've talked about in business before, and in economics too, and they are fixed and variable costs, okay? And they are two significantly different types of costs. Okay, so a fixed cost, any fixed cost that we could say that we've got in a business is basically one that stays the same regardless of the amount that we produce, the amount of output that we produce. So examples would be things like rent or managers' salaries. That they are not going to change if we produce more or less in terms of output. So fixed costs are those that stay the same regardless of the amount we're producing. Another type of fixed cost could be interest on bank loans. That isn't going to change from one year to the next based on the agreed negotiated bank rate of interest that you're being charged for your loan. Okay, so if a business borrows £30,000, annual rate of interest is 7.5%. Then we can calculate our total annual interest that we have to pay. So we take 30,000 times it by 7.5%, and that gives us 2,250. And we know that that is what we're going to have to pay for the in terms of interest for the entirety of the loan. So we know that that is essentially a fixed interest payment of, in this case, £2,250 per annum. And that's what we would have to pay each year that we had that loan. Okay, and now if we take a look at fixed costs then and how they're shown on a cost and revenue graph, then in this instance, fixed costs are always going to be shown as a straight horizontal line when shown on a graph, because they're not going to vary. They are not going to change with the number of items that we produce. If we produce nothing, no items of output, we still have fixed costs, because they are costs that are that we're going to have to incur regardless of the output that we produce. Okay, so an important principle that fixed costs are always shown as a straight horizontal line when shown on a graph. Okay, let's take a look then at variable costs then, and pretty much as the title suggests, when we've got variable costs, we've got costs that are going to change in relation to the number of items that we produce. So for instance, raw materials will change. If we produce more and sell more, and we have larger amounts of output, the raw materials for each item of output are obviously going to increase over in terms of the total amount of cost that we have as output increases. Now, in this instance then, let's just move me down there a minute so you can see this slightly better. So we got variable cost per unit, or average variable costs, and that we can actually multiply by the number of units to then calculate our total variable cost. Okay, so in this instance, we might be given that information. We might be given the variable cost per unit, or the average variable cost, and then we need to multiply that by the number of units to get our total variable cost. So as you can see in this instance, if we know what our average variable cost is, we can times that by the quantity of units that we're producing, and that will give us our total variable cost. Now, in this instance, our variable costs are going to start at 0 and slope upwards when shown on a graph. Okay, so if we're showing variable costs separate from fixed costs, that's the way that would go. It's not dissimilar in some ways to the way in which the revenue graph is shown, where we've got our variable costs starting at 0, where we have no input at all, and then increasing as we actually increase the number of items. Okay, so that's we've talked about variable cost, and we talked about fixed cost. Now we need to look at total cost, and in some cases, in this instance, we need to then bear in mind that we're going to have to combine a couple of things to be able to calculate our total cost. So in this instance then, total cost basically is where we take our fixed costs and we add our total variable cost. Okay, and that gives us the total cost of producing the goods and services that we are selling. Okay, so effectively our total cost, and then this is shown in a formula, total cost equals fixed cost plus total variable cost. And actually you could also put total fixed cost, so TFC there, plus total variable cost to give our total cost overall. Okay, now in this instance then, we need to show that the total cost is obviously going to be a line which is sloping upwards, but effectively what we've got to bear in mind that our total cost is going to include fixed cost plus variable cost. So in this instance, you can see a similar sort of situation where we've got our variable cost at 0 items, but it's not starting at the origin. That's because clearly, as we said before, we've got fixed costs, and if you think about fixed costs, if it's at this point here and we draw a horizontal line across like so, that would be our fixed costs, which are not going to change with output. So effectively our variable cost, in order to calculate our total cost, our variable cost will start not at the origin when we're looking at the total cost curve. They will actually start at the point at which the fixed cost line starts. Okay, and then clearly in this instance, this line is showing us the total cost line, and as a result of that clearly is hopefully a figure or a line that at some stage our revenue line is going to cross over, and we're then going to start to make some profit. But again, we'll talk a little bit more about that in some of the future presentations that we'll go through. Okay, so what I'd like you to do is have a look at drawing one diagram and show all 4 lines. Show the revenue line, show your fixed cost line, show your variable cost line, and your total cost line. And then you should be able to, particularly when we start to look at break-even analysis, you should be able to see that there is a point at which revenue will hopefully be higher than total cost, and then that's the point at which you start to make a profit. However, before that point, if revenue is lower than our total cost line, then clearly we are making a loss. I'll leave you to ponder that, and if you're not quite clear on that, obviously that's something that we can talk about when we catch up for our live session a little bit later on in the week. Okay, so hopefully that's all clear so far. Let's move on. Okay, so we talked about total cost. We also, particularly in economics, need to talk about average cost and be able to calculate average cost as well. And we'll talk about the reasons for that again a little bit in the future. Okay, so average cost, basically AC, or total average cost, or average total cost, is ATC, is the average cost of producing a unit of output. Okay, so in this instance, we calculate it by taking our total cost and dividing it by the number of units of output, and that gives us our average total cost. Now, as output rises, average cost will fall because effectively, if you think about it, fixed costs are being divided by a higher level of output, and fixed cost per unit come down. And in this instance, as output rises, average cost will fall for that very reason. So if we take a look at how we might calculate a firm's cost, now you might think, how the heck can we actually fill all this in with so little information? Well, it's pretty straightforward, really. If we've been told our total fixed costs are £100, okay, and our variable cost per unit is £10, we should be able to fill in that table. And I'll give you some time, just have a go at completing that, okay? Total fixed cost, what is your total variable cost, what are your total costs, and then also what is your average cost. And you should be able to calculate that with the small amount of information that you've been given there. Okay, so I'll give you some time to do that, and then we'll move on to the next slide and we'll take a look at what that looks like. So welcome back, and basically let's take a look at these figures. So effectively what we've got here is our total fixed cost of 100. We were told that our total fixed cost was 100. So regardless of output, whether we produce 0 or 5, our total fixed cost is going to be 100 for each one of those. Okay, so no variation in cost, because our total fixed costs, we know that they are not going to vary with output, and they will stay the same irrespective of how much we produce. Our total variable cost, if we're producing nothing at all, that cost is nothing. If we're producing 1 unit of output, that's 10. We've been told our variable cost per unit is £10. We're producing 2, it becomes 20, 3, 30, 4, 40, 5, 50. Okay, and then effectively to calculate our total cost, we're going to add our total fixed cost and our total variable cost. So our total cost at output level of 0 is 100. At 1 unit of output, it's 110. At 2 units, it's 120. At 3 units, it's 130. At 4, it's 140. And at 5, it's 150. And then to calculate our average cost, where we're basically taking our total cost and dividing it by the output, you can see that our average cost, well, we can't calculate it for no units of output. For 1 unit of output, is £110. For 2 units, it's 60. For 3, it's £43.33. For 4, it's £35, and for 5, it's £30. And the reason why that average cost is coming down is because our fixed cost in this instance is spread across 1, 2, 3, 4, and then 5 units. Hence the reason why, although total costs are going up, the average cost has come down significantly for that very reason. Okay, so let's take a look then at calculating revenue and cost then, okay? So in this instance, we've been given some information. So we've got a selling price of £15, we've got a quantity sold of 100,000 units, and we've got a fixed cost of 40,500. We've also been given our average cost per unit of £6. So you should be able to, with a few calculations, be able to calculate what the sales volume is, what the sales revenue is, what your fixed costs are, and what your total variable costs are, and also what your total costs are, okay? And all you've got to do really is look back at some of the slides that we've just gone through together, and you should be able to, with a little bit of sensibility, you might need to make a few notes and just think about the formulas that you need to use. You should be able to calculate those in a very straightforward fashion, okay? So let's move on. I'll give you some time to calculate those, and if are there any issues when we come to talk about those during our catch-up later on in the week, then obviously we can run through those together then. But I'd like you to have a go at completing those relatively simple revenue and cost calculations. Okay, another test then. Okay, so just to make sure that you do understand those principles. I think they might actually be the same figures, aren't they? They are in fact the same figures. Okay, so the test yourself is basically calculating those items there. So a bit of duplication there. I do apologise about that. I didn't realise that was going to be that exactly like that. But again, you can test yourself. Let's take a look at the next thing then, which is percentage change. And then once we've calculated a couple of percentage change examples, I think that will be sufficient for this particular unit. Now remember, guys, that on page 98 of your booklet, chapter 19, calculating revenue and costs, there are also some notes which you might like to take a look at, which show the range of things that we talked about here, and also a few other graphical examples in terms of how total costs are made up. But this all sort of works together with the presentation that we're just talking about now. Okay, so percentage change, really important that you can remember how to calculate a percentage change. Okay, the number of times that these sorts of things are asked about in economics exams and economics questions and exercises, and you would be quite surprised at the number of people that can't remember how to calculate percentage change. So make sure that you can remember it. Okay. Very simply, percentage change is calculated as the original figure, take away the new figure, times that by 100, and then divide that by the original figure to get the percentage change. Let's have a look at an example to help you with that then. Okay, so in this instance, we've got fixed costs that have increased from 50,000 to 52,000. So our original figure was 50,000, our new figure is 52. And then we need to calculate the difference between the two and then divide that by the original to get, in this case, the percentage change. So effectively, our original figure was 50,000. Our new figure is £2,000 more. And so when we calculate that and divide it by the original figure, that gives us a 4% increase in fixed costs. Okay, it's as simple as that. It's just the original figure compared to the new figure, what's the difference between the two, and then divide whatever that difference is by the original figure, times it by 100, and that gives you your change in a percentage change in the figures. Okay, so a practice question here then. Sales revenue has fallen from 1,250,000 to 1,190,000. So calculate, in this case, what the percentage change is. So just use those same principles and see what you can come up with as a response to that. Okay. So that's basically the chapter 19, calculating revenue and costs, completed. It's a relatively short presentation, as I mentioned, but at least that hopefully gets you thinking, gets your juices flowing for a few calculations. I know some of you are not particularly comfortable with calculations, but these are some of the main examples and things that you need to remember and have at your fingertips in order that you can calculate these easily without it being a real stressor in an exam scenario. Okay, so we're going to stop there, and I look forward to catching up with you later next week. In our live lesson where we can take a look at any of the work that we've completed in the various presentations that you've looked at this week. Okay, so thanks for listening, and we'll catch up soon.